talking about the next wave of investing, geopolitics, and technology, and we're talking about that against a backdrop of rising uncertainty in the world today. We talk about policy, Fed in particular, and can the Fed navigate, engineer a soft landing? We have China. Is it really different this time around, given the stimulus that we saw just recently? I know traders say it's not enough, but what is enough, Rohit? And of course, we have escalating tensions in the Middle East. We've seen oil getting to 80. Might it get to $100 a barrel, like some people suggest? As it stands now, we're awaiting the reaction from Israel to that Iran attack. And of course, when it comes to technology, AI disrupting, reshaping sectors at scale, what do you do about that? For a CIO who's overseeing about 300 billion US dollars, how do you look at the macro environment?
Look, we've had a period of time where there have been a lot of uncertainties in the environment, and so you can just get paralyzed with all the risks that are there. At the same time, you've got a US economy which is still robust. It's slowing a little bit, but with the Fed having indicated it's going to aggressively cut rates to preempt any risk of a recession, I think the chances of a soft landing have become significantly higher. And one expects post the elections you will see a pickup in investment and growth in the US next year. China was going through a major deflationary downturn. We'll have to see whether that's structural or cyclical, and I think part of it depends on the actions that they're taking right now. They've unleashed a monetary bazooka, but it's clear that a lot of fiscal action is going to be required, and over the next few weeks, we will see whether the steps they're taking are effective and enough, right? Emerging markets, to be fair, particularly the ones in Asia, if you look at the last 10 years, earnings growth have been close to zero. This year, they're about 15% and expected to continue at that pace for the next couple of years. So the outlook, particularly in an environment where the Fed is cutting rates and the dollar is weakening a little bit, actually looks pretty good. It's a good environment for emerging markets. But there's a risk of the US elections. And if you have a Trump presidency and 60% tariffs of China, across-the-board tariffs in the rest of emerging markets, the rest of the world, in fact, you would probably see a stronger dollar, may create inflationary pressures and therefore less of a rate decline. And you will probably see, it's not an environment that should be very good for emerging markets. So there's that uncertainty. So ultimately, look, there are a lot of uncertainties. You mentioned the wars, Russia, Ukraine, which most people have almost got immune to, has been going on for so long, unfortunately so. And what's happening now in the Middle East. So for us, the most important thing is, look, there will be these uncertainties. How do we make sure the portfolio we have is resilient across different environments? And therefore, you want to have your portfolio weighted towards companies that have strong cash flows, stable cash flows across different environments, and are likely to be better suited to withstand shocks around AI, the green transition, and geoeconomic fragmentation, three of the probably the most important risks we look at right now. So that's what you've got to do. Look, there are risks, but there are opportunities. It's not that the world is collapsing. And you've got to try and have a portfolio that's resilient across different environments, even if you're sacrificing some upside, so that you have more stable growth and more resilient growth.
Before we unpack what you have just said, I just want to take a look at the appetite for risk. It's very different now compared to 12 months ago, just 12 months ago. There's greater risk, greater uncertainty. Yet there seems to be a lot of complacency. You take a look at the S&P, it's record after record. In fact, just yesterday, it was the 44th record for the S&P. Are we underpricing? Are we underestimating risk?
So I would clearly agree there is complacency. But the difference compared to a year ago was that we were very worried about getting into a recession. If you remember, yields had gone up to 5%. Inflation was still high, so you felt that the Fed would not pivot till inflation came under control. The risk of a recession was high. Most people you talk to said, look, we're probably going to enter a recession. Today, that environment has changed. Inflation actually has come under control. You have a Fed clearly indicating they're going to cut aggressively to sort of support the economy. So from that perspective, and you've got a situation, if I think about coming into next year, with the focus on reshoring, the focus on green transition, the focus on AI investments, you should see growth pick up quite well. So there are actually some positives out there. I think the key issue, the key risk, particularly with the US market is concerned, is a lot of the good things are priced in. The market's trading at 22 times earnings, projecting actually about 14% growth next year. That's based on a 5% sales growth and assumptions of expanding margins from what are already peak margins in history this year. So the potential upside at the market level probably is more modest. It's very difficult to think of double-digit returns in the next 12 months on the S&P, and I'm sure I'll be proved wrong. But, but within that context, there will be probably rotation, right? Because if you have rates being cut, you're seeing outside, the market's been very driven by the tech sector and large cap tech first half of this year. The third quarter was interesting. You had the S&P up 5%, the S&P equal weight was up 10%, and the Mag 7 was flat. So you're seeing a rotation now to a broader group of companies that are going to be benefiting from the environment we're getting into. And therefore, it'll be very much a bottom-up market to pick the right stocks rather than just bet on the index level.
Let's pick on technology. You, I think as of June, invested billions in US tech, the likes of NVIDIA, Amazon, Alphabet. What's the upside for these stocks, you think? Because some people are saying they're either close to peak or they have peaked already.
So these are very high quality companies riding on a trend that we see is going to be a strong trend for at least the next several years. You know, are they expensive? They're not cheap for sure. But as an aggregate, if you look at, I call them the Mag 5 now, but keep out Apple and Tesla, slightly different category. But they trade at probably 29, 30 times earnings. So it's not cheap, but their earnings this year have probably grown at 29, 30%. And are projected to grow at close to 20% in the next year. So I wouldn't say that they're like hugely expensive either. But can you expect outsized returns of 20, 30% a year? Probably not. But can you, from this company which is benefiting from AI, and they're enablers of AI, which we don't think is going away, will they be able to deliver you returns in the teens? You know, probably yes. It's not an unreasonable assumption.
So it's still not too late to get into these stocks?
Yeah, you've got to look at each one bottom up. And, you know, at times, I mean, even NVIDIA, sort of the stock moves 10, 15% on an earnings day, right? So there are periods of exuberance when they overshoot, and, you know, you've got to just be conscious of that. But, you know, they also pull back quite a bit. So I do think there are opportunities even in these companies and other companies, whether it's sort of the Microsofts of the world, et cetera. I mean, the cloud companies and those that are actually using AI to enable their businesses. There clearly is upside there, and you just have to look at it bottom up, stock by stock, and, you know, factor in valuations.
You talked about how AI is not going anywhere. How do you still play the AI space? I mean, we just start looking at India, for instance, which has a dream of becoming an AI hub. We know Modi has a dream of doing that. We also know that Japan wants to play AI, be a big AI player. Would these be alternative plays for AI?
So I would say the first wave has been investing in the enablers, the infrastructure players, whether it's the chip manufacturers, chip designers, companies like NVIDIA, or it's basically the semi companies like TSMC, or it's the cloud companies like Microsoft and Amazon, et cetera. The next wave will be, and by the way, where that segment is concerned, I don't think you can have countries like India really play that. It's too far up the tech stack, and there's too much required to get there. These chip design companies will offshore and use people in India for their design work. And so India may benefit from that perspective, but the IP is not going to be there. It's going to be in the US or in Japan or elsewhere. So the question out there is that, so that's where I see the opportunity there. Now, the next wave is going to be the AI adopters who can actually use AI in their businesses for efficiency, productivity, but also potentially to position themselves as their competitors. And that's going to impact every industry. And they're going to be winners and losers. And in our case, that's something we're very focused on with our portfolio companies. Where are you placed on that AI chain? How well equipped are you to address that? And that's where I think actually Indian companies are going to be in a good position to adopt AI. And there you will probably see that adoption maybe more so than other countries. But I don't think they're going to be at the forefront of what we're talking about right now in terms of the infrastructure and the chips and generally what we call the enablers.
Let's talk about China. It's been front and center on everybody's minds, given what we saw, that bazooka of stimulus recently. Is that a game changer? Does it signal perhaps we're on the cusp of a reversal in sentiment in China?
So as you said, the key issue in China has been a crisis of confidence amongst consumers, amongst entrepreneurs, amongst investors. And there's been a self-reinforcing downward spiral. So how do you break out of that? For the consumer, the two big issues have been the value of real estate, which is 60 to 70% of their household wealth, has been steadily declining. That's not an environment that engenders confidence. And there haven't been jobs. That's not, again, good for confidence either. Entrepreneurs have seen their stock prices fall 50% in the last 3 years and have been worried about regulation, about, in fact, personal safety also. And that's not been a great environment for them to sort of invest out there. And investors, given US-China tensions, the Western approach to China, I mean, people have been uncomfortable investing in China. And the big opportunity would have been for domestic capital, because domestic savings are huge in China. That could come into the market. And the problem has been that their options earlier were to invest in real estate. They can't invest in real estate. They used to invest in these trust products, which are not really trustworthy any longer. And then the third option now is either you get 2% in the bank or you invest in the stock market at 9 and 10 times earnings. But given the lack of confidence, they preferred to earn 2% in the bank rather than go in the stock market. I think the steps the government has announced is trying to break this logjam and create that confidence which would create a virtuous loop. So most importantly, arrest the fall in property prices. Secondly, have this consumer stimulus, transferring money to people who need it, reducing mortgage rates so people have more money to spend, and doing a bunch of things around that which at least creates the desire to spend, and they would spend if confidence comes up. And on the entrepreneur side, by creating a boost to the stock market, hopefully creating some confidence, and signaling to them that, look, we're going to be behind you, giving instructions to the local governments not to harass them on 20-year back taxes, etc. Now, the first step was being done in terms of announcing the monetary policy. The big issue is going to be the fiscal policy. What's going to be the size? And most importantly, how is it going to be implemented? Because on the real estate side, they have in the past talked about allowing local governments to raise bonds that they can use to buy property inventory and support prices. But the cost of borrowing was higher than the yield they were getting on rentals of the property they bought. And the local governments don't have the financial capacity to sort of, their balance sheets are in bad shape. So nothing happened. I mean, you had the policy, but it couldn't be implemented. So the way this is going to be implemented is going to be fairly critical. And I think over the next few weeks, we should get more clarity on that.
You talked about the size of the fiscal stimulus. What is big enough? The numbers out there suggesting 2 trillion yuan, 3 trillion yuan, I think, according to Citi. If it were to announce 3 trillion, would that mark a turnaround? I mean, what are you looking at? What numbers?
So to me, more important than the size is how is that going to be implemented? Is that money going to do what it's intended to do? As I said, arresting the decline in property prices, the way it's implemented will decide whether it can happen or not. If it's moving in the right channels and they find 2 trillion is not enough, they will put more. So it's a question of just, okay, it won't happen now, it'll happen a little later. But you have to see effectiveness of that policy. And I think to me, that's the most critical thing.
What are you seeing on the ground in China? You're an investor in malls in China, in what else?
A lot of everything.
Offices.
Internet platforms
so
and consumer companies and everything else.
So what are you seeing on the ground? What signals are you getting?
So the last quarter things had really slowed. Consumption had really slowed. In fact, I potentially think that the reason the government acted with this bazooka monetary policy was because you saw youth unemployment significantly going up. I mean, the numbers keep changing right now, but anecdotally we hear that they were concerned at the numbers going up. Revenues of the provincial governments were going down sharply. There was concern, I believe, even among some of the SOE real estate companies voicing concerns that, look, if this was not arrested, they could not continue to function. And so there was a realization that, look, we need to act quickly to sort of reverse things, which is, I guess, a good thing that they had that realization and they've announced an intention to do something. So to me, what it tells me is that the left tail of China getting into a downward spiral on growth, that's largely been taken away by the expression of intentions by the government. Now, from here, to what extent do you address deflation and get back to a growth trajectory that is acceptable to investors? That will really, as I said, depend on implementation of policy and the effectiveness of those policies. Because if you need to get back, if we can get this cycle, as I said, even in terms of domestic investors, domestic consumers, if they can put their savings in the stock market, that itself will create a virtuous cycle of wealth and confidence together with the real estate arrest of prices.
The thing is, domestic investors have been pumping money in. And that begs the question, can China actually not follow through with the promises it's made?
So look, they've really started coming in only in the last 2 weeks, right? China has always had its own priorities, right? And the priority right now, it so far seemed to be, we want to make sure that we are sort of supporting the supply side, developing competitive industries to be able to compete on the global stage, and focus on being self-sufficient in the context of this US-China conflict. And in that sense, consumer stimulus and growth potentially took a bit of a backseat, till it reached a point where they decided that, look, it had gone too far. And that's probably what led them, and look, this is just an interpretation of everything that sort of happened, that's what led them to act. So as I said, the left tail's probably been taken away of a major collapse in sort of growth. But what will then be the acceptable level of growth and what it means for earnings and stock market, etc., it's difficult to say that. We'll just have to see how things work out.
5% growth achievable this year?
5 is, whether it's 5 or 4.7 is probably less relevant. What's relevant is that right now, that was real growth, but you had deflation. So nominal growth was 3 to 4%, and that's what drives companies' earnings. If you can move away from deflation to plus 1 to 2% inflation, I think that's the most critical thing. It's not going to happen overnight, but if it moves in that direction, I think that's what's going to get people more confident about China.
If I got it right, for the first time in about a decade, your allocation to China is actually lower than the US. What would it take for you to reverse that?
So to be fair, the reason most allocators would have more allocated to the US than in China.
You had a lot in China.
But that was the context of that was that till 2014, we were only an emerging markets investor, had no offices in the US and Europe. So we were starting from a very small base. So actually the US has been the largest beneficiary of our capital since we opened the office, because we were starting from such a small base. And in most normal situations, you would expect the US to have a high allocation in China. So I don't see that changing. The question in China has been what we invest in. And we've been sort of rotating the investments that we've had into sectors that we felt were more domestic market oriented. So not, well, general consumer stuff could be anything from cosmetics to consumer durables to anything else, right? To gaming, etc. Or sectors which are not likely to be in regulatory crosshairs. So you've got to be careful about that. And sectors that were not likely to be tied up in US-China tensions as such. So it narrowed the opportunity set that you had, but there were still enough opportunities. And I think that's where we've been shifting our focus to within China, where there's still very high-quality companies, very high-quality entrepreneurs. And the last thing I've said is that we focus more into just some pure growth to companies generating solid cash flows. Because in an environment where you don't have Western capital coming in, you either have domestic capital that will sort of be a buyer of your stock, or if your company itself generates a lot of cash flows, you pay out dividends and buy back your stock. And there are many companies in China now where have the combination of buybacks and dividends is giving a mid to high single cash flow yield, high single digit cash flow yield, which itself becomes attractive, and then you have even 5% growth and you get double digit returns. So the nature of stuff where it was last decade it was all growth, growth, growth. Now it is, growth's important, but cash flows are very important in the context of not having bids from investors, external investors.
We know that the US election is important to China. It's not about whether it is Trump or Harris. It's really about the trade policy and the tariffs that you talked about. How much of an impact might it have on China if, for example, Trump delivers on those promises?
So look, a 60% tariff on China, if implemented, will clearly have a negative impact, right? So far, this year, when most engines of growth have been slow in China, the export engine has been strong. At the end of the day, if you look at the numbers, and I don't have them off the top of my head, but the US accounts for not a very significant portion of China exports. It's probably somewhere in the teens, I think. I may be wrong on that. So yes, it will get impacted, and it will impact growth. I think it'll impact sentiment. So I think it's going to be negative, but probably in preparation for that, or the risk for that, was probably another factor why they felt they had to sort of drive home domestic stimulus to offset any risk of major shocks from that. China will ultimately still have to be driven by domestic consumption. I think that has to be the major driver going forward of its growth. Exports will be important, but given geoeconomic fragmentation, I can't see it being the same growth engine as it's been in the past. So you've got to stimulate the domestic economy for that.
What opportunities might there be for investors? Because we talk about how, countries benefit from a China plus one, China plus two strategy.
So particularly in this region, both Southeast Asia and India are going to be big beneficiaries of this supply chain diversification out of China. Actually, interestingly, some of the biggest offshorers out of China are not MNCs, they're Chinese companies themselves. Because they realize if they have to address markets in the US or Europe, elsewhere, that they need to have a base outside China which is seen as somewhat independent from China. Now, unfortunately, India is not receptive to Chinese entrepreneurs coming and moving, setting up things. So actually, ASEAN is a huge beneficiary of that. Malaysia, but Vietnam has been a big beneficiary. I would say across the region, I would see this region benefiting from that a lot. And when it's multinationals sort of moving out, I think this region will benefit, but I think India will also be a big beneficiary out there because India has the scale for some of these multinationals to really scale up what they were doing in China. It will take time, but I do think that's a big opportunity. So in India, we've traditionally invested in things like financial services, healthcare services, consumer. But the one area which we're increasingly looking at right now is also manufacturing, logistics, warehouses, because we do see that being a new growth engine for India because of this.
7 minutes to go, still a lot to cover. I want to cover the private space, private equity. I mean, we talk about how fundraising has kind of been pretty lackluster. We have not seen the kind of recovery that we anticipated. Are you worried? How are you looking at it?
So a lot of private equity players have their average period that they've held their assets for is well over 5 years now, which is much longer than they've historically done it. And part of it has been you've had a weak IPO exit market, M&A has been sort of slow. So that is a challenge. And they've been reluctant to, there's a lot of dry powder from new funds that have been raised, but the existing funds have been reluctant to sell at prices that they would consider to be cheap for good assets. I think we're getting close to a breaking point where they can't hold off much longer. So one of the things that they're trying to do is set up these continuation vehicles where one of the new funds will buy over the assets and you get a third party to come in and price the deal and come and invest alongside them. And they want to do this for their best assets. So actually for investors like us who have liquidity right now, we see that as a very interesting opportunity for us to come in and find some really good assets in the private equity firms and look to sort of invest alongside them in their continuation vehicle. So that's an opportunity. But ultimately, look, we can please keep playing this game about one fund buying from the other and so on and so forth. Ultimately, we do need to see a pickup in the IPO and the M&A market for these private equity funds to realize good value on their investments and deliver returns anywhere close to what they did in the last decade. I suspect we had really good returns in the last decade. They will be lower this year. But if you can still get something in the low to mid-teens, it's not so bad.
Can you share, like, in terms of geography, in terms of sectors, where you find these opportunities?
Well, the continuation funds are mostly in the US and Europe. You're seeing a lot of that out there. And it's more in the buyout space. To be fair, you can buy secondaries for VCs and growth funds at massive discounts. But that's partly, I think, because a lot of funds haven't marked them down to realistic values. And there haven't been new fundraisings out there. So for us, actually, the most attractive area right now is controlled buyout deals which have companies which have strong cash flows, which have had a good history and track record, and where we can come in to provide liquidity to a fund who needs to return liquidity to its investors.
How about in terms of private credit? There are views out there that perhaps a lot of lending is being made to companies that actually deserve to go bust. And I think the likes of the ECB had come out to say, you know what, you need greater, I guess, scrutiny on such activity?
So I would say, based on our experience with the private credit firms we deal with and our own private credit pipeline, because we do invest in the space, you've seen spreads compress over the last year. Deals that were done at SOFR plus 650 are being done at 450 or 500. So yes, less attractive from a return perspective. But we haven't seen a significant deterioration in underwriting standards. There's been some, but not at a level where I'd be usually concerned. And even when I speak to our private equity GPs and their underlying portfolios, because they're the ones actually who take a lot of this private credit to finance their deals, they're not seeing that much stress in their portfolios. And I think partly it's because the economy has been holding up. So I'm less concerned at this point. There is a lot of money, and so my concern is more about returns and yields compared to what we could get in the past.
And of course, the likes of PGIM CEO David Hunt, I had a conversation with him recently. He talked about how the private and public space will kind of merge, becomes one convergence, he says, because the likes of Temasek has been playing a lot in the private space. Do you see that happening?
So from an investor perspective, there's increasing allocation to alternatives. That is happening. But it's not that people are just going to go completely in one direction vis-a-vis the other. But yes, allocation here is increasing. There's also this issue about, in the public markets now, if you're a small cap company or even a $4 or $5 billion company, depending on where you are, if you're a $5 billion company listed in the US, you get no investor attention. I mean, a $20 billion company now in the US is considered a mid-cap, for example. So companies are being forced to stay private longer because if they go to the public markets, they don't get the right reception. So in that sense, more assets are going to be in private hands for longer. You will see more growth companies as they mature, not going public, but being sold to more mature, later stage private equity companies. Some of those companies will sell to the next private equity company before ultimately it goes public or gets sold to a strategic. So I do think that you're seeing more capital moving to the private markets, and it's a trend which seems to be there.
You seem pretty upbeat. House seems to be in order. What keeps you up at night?
Look, as you started off, there are a huge number of risks there, right? I mean, we have...
What's the biggest one for you?
So it's the biggest one that we could... So I think about risk that we can do something about and risk that we can't do anything about, right? So for example, the Russia-Ukraine war and how that sort of shapes up, or what happens in the Middle East. All I can do out there is...
More to do with oil getting to $100 where you have to reassess all your...
Less so that, because even if it does, I think that's going to be temporary. So for us, it's more important, therefore, have companies with lower leverage, generally strong cash flows. Yes, you have a short-term problem because oil spikes to 100, but you can survive that and then you'll come out of it okay. So that's less of an issue for me. So therefore, the risks that I worry about more are this geoeconomic fragmentation, what that means for companies' markets, access to supply chains, access to technology, and therefore it comes back to the type of companies we would invest in. The AI is a risk and an opportunity. It's definitely a risk. There are a lot of traditional businesses which you don't feel it today, but suddenly in 3 or 5 years, if they have not investing in it, will find that they're being left behind. And that's a very key focus for us with our portfolio companies. And then lastly, which is being talked about less, but I do think will ultimately come back to haunt a lot of companies, is this green transition. You know, if you're a high carbon emitter and are not doing something about it, it will ultimately come back and cost you either in terms of dollars and increasingly otherwise in terms of your customers or employees, etc. But it is an important thing, and it's been pushed to the back burner for a while. But given the number of weather catastrophes you're happening, it will come to a time where it will become high on the political agenda. I don't know whether it's in 1 year, 3 years, or 5 years, but it's something we think that. So those are the risks I worry about the most and look to see that we're investing in companies that are resilient to those.
That's the risk you worry about the most, but what's the opportunity? Because we just had Milton making a landfall on the back of Helene. Are there opportunities for investors?
Definitely, right. As I said, on AI, for example. Clearly, there will be winners out there. And outside the enablers, the adopters, we have to look at them and saying, which are the traditional industries where this is not being priced in, and which, if they're going to be winners in that space, how do I get behind them? On the green transition, there is significant opportunities in terms of acquiring brown companies and converting them into green and getting a multiple re-rating and strong cash flows at the same time. So there's significant opportunities out there. We just partnered Brookfield to take private of a renewables company in France called Neom, but they're fairly globally based. There are other situations that we are looking at where there are plants which are more brown and we need to sort of convert them into green. So there are significant opportunities that we are looking at.
Just one final question before I let you go. If you had $100,000, how would you allocate it?
So given the risk that you're talking about, I would be diversified, right? So I can't say I will allocate everything to the US because, to the point I made earlier, if you look at where we are on multiples and where we are in terms of margins in the US, at an index level, it's very difficult to see yourself getting double-digit returns over the next 5 years. It's probably going to be more like mid-single-digit unless we see some major productivity improvements through AI. So the US has the best companies, the most efficient companies, the best entrepreneurs and innovation. So it has to be the biggest chunk of my allocation, but it's not going to be the 66% that it is in MSCI ACWI, because that's too much, because US exceptionalism will continue, but not to that extent, is my view. So US will be the largest allocation. And then you've got to sort of divide. India is going to be important. It's not going to be, it's going to be much bigger than its weight in ACWI and bigger than its weight in global GDP because of the importance we see there. And we're looking to increase our allocation out there. Japan is interesting because it's structurally sort of changing. And then actually China is a big diversifier because it's going to be more or less, it's going to be less correlated with the rest of the world in that sense, like equity markets. So I do think it's important to have your allocation. By the way, this year China is now the best performing market in the world, year to date. So
50% to the US, 30 to India, 20
No.
to, what was it, Japan?
Yeah, maybe 40 to 50% to the US. Okay, India would be, maybe 10 to 15%. It's not right now as big an economy to sort of justify putting much more. Its weight in ACWI is probably 3 or 4%. China should get at least that amount, maybe a little more than that, but at least around that much. Europe, also 15, 20%. I mean, I'm just giving you rough numbers. The important thing is you've got to be diversified. You can't put your bets in one basket. And increasingly, you've got to be in an environment where you could expect rates to be slightly higher. You could expect more inflation. You could expect uncertainty. So the more important thing for me is across these things, having 60 to 70% of our portfolio, which is what we call resilient, stable cash flows, less volatile, the balance 30 to 40%, higher returns, but a wider cone of outcomes. And so more uncertainty there. So you play for the upside there, but your core of your portfolio has to be stable to ride through the uncertainties that we have in the environment today.
Rohit Sipahimatlani, we thank you so much for your investing insights today. Ladies and gentlemen, a round of applause, please.